Last week, I logged into one of my credit card accounts to make a payment. Before I could even see my balance, a bright banner popped up across the screen. Update your annual income to help us better serve you. Friendly wording, clean design. My old income was already filled in. All I had to do was type in a new number and hit submit. Help us serve you better. Let's be honest, that line isn't for your benefit. It's for theirs. Because the second you update that number, something starts happening behind the curtain. Algorithms fire, risk models adjust, marketing categories shift. Your financial profile gets quietly re-optimized, not for your outcome, for theirs. Most Americans treat income questions like their routine. Of course they want my salary. Of course they need to know. Here's the truth. In most cases, they don't need it, they want it. And that distinction matters more than people realize. The first thing you need to understand: there is no law that says your credit card company must know your current income at all times. When you apply for a mortgage, yes, federal rules require lenders to verify your ability to repay. That's a hard requirement. Auto loans often require income disclosure too, depending on the lender. But those random update your income pop-ups inside your credit card account? Completely optional. They're framed like administrative housekeeping. They're actually data collection, and data is money. The second you enter that number, let's walk through what actually happens. You type in your updated income. Maybe you just got promoted. Maybe you jumped from $75,000 to $110,000. Maybe you cleared $180,000 last year. You click Submit. Behind the scenes, your risk profile refreshes. Your lifetime customer value estimate recalculates. Your marketing tier updates. This affects your credit limit, your interest rate offers, the products pitched to you, the fees you'll be shown, how aggressively they market to you. You won't see any of that happening, but you will feel it. Higher income does not automatically mean better treatment. Here's where most people get it wrong. They assume higher income equals lower interest rates, better terms, premium treatment. Sometimes yes, but not always. There's a pricing model banks use called ability to pay. It works like this. If the algorithm believes you can afford higher costs without leaving, you might actually get worse pricing. Why? Because you're less price sensitive. Someone earning $200,000 may not switch cards over a 2% APR difference. Someone earning $55,000 probably will. Guess who gets optimized more aggressively? The one who won't complain. Your income doesn't just tell them your risk, it tells them how much they can push. The credit limit illusion. Let's talk about something people celebrate that they shouldn't. Credit limit increases. You update your income, and suddenly your $12,000 limit becomes $22,000. Feels like a win, right? Wrong question. The real question is, does a higher limit actually improve your financial life? Because statistically, higher limits lead to higher balances. More available credit makes spending friction lower. More balances mean more interest payments. Banks don't extend limits out of generosity. They extend them because larger balances equal larger profits. They're not giving you financial freedom. They're giving you more runway to carry debt. How you get reclassified. Here's something most people never notice. The moment your income crosses certain thresholds, your relationship with your bank changes. Clear $150,000? Suddenly, premium travel cards show up everywhere. Annual fees north of $500 start appearing. Update to $200,000? Now you're getting private client pitches, wealth management invitations, pre-approved personal loans. Your income doesn't sit quietly in a database. It triggers targeting, and targeting means upselling. Lower-income customers get a different version. Balance transfers with hidden traps, high-interest installment loans, aggressive fee-based products. Precision marketing only works when the data is fresh. That's why they keep asking. Stale data is less powerful. Banks love recent information. A 5-year-old income number is less predictive. A number updated last week is gold. That's why they nudge you every few months, not because they care about accuracy, because fresh data improves optimization. If you don't update it, they rely more on behavioral signals, your payment history, your utilization ratio, your account age, your spending patterns. And here's the part that should matter to you. Behavioral data is harder to exploit than self-reported income. You can't fake consistent on-time payments. You can't manipulate long account history overnight. Your actions speak in a way self-reported income never will. When you do have to provide income, let's be clear, there are times disclosure isn't optional. Mortgage applications? Required. Income verification is federally mandated. That's non-negotiable. Certain loan approvals? Required. Apply for new credit? You'll need to state income. Do not lie, ever. That's fraud. It's illegal and stupid. But here's the difference. Required is different from requested. An application asking for income during approval is one thing. A pop-up inside an existing account asking for updates to help us serve you better, that's optional. You can close it. Nothing happens. Your account stays open. Your credit score doesn't drop. They'll ask again in 6 months. The economic downturn factor. Here's a layer most people ignore. When the economy tightens, banks review portfolios. They decide who to cut limits on, who to close, who to reprice. Income influences that. High income might signal strong repayment capacity, or it might signal opportunity to increase rates because they can handle it. Lower income might trigger precautionary limit reductions. The only consistent way to avoid being algorithmically sorted by fresh income data is simple. Don't constantly refresh it. Force them to rely on your track record. If you've paid on time for years and kept low balances, that speaks louder than a salary field. Why this feels mandatory, even when it isn't. Banks are good at framing. Forms feel official. Pop-ups feel urgent. Phone calls feel authoritative. It's psychological pressure. They create the illusion of requirement. Most people comply because non-compliance feels wrong. Try ignoring one next time. Just close it. Watch nothing happen. Your account works exactly the same. You'll realize how much of financial compliance is learned behavior. Let's get practical. Here's how you should handle income disclosure going forward. New credit card application. Provide accurate information. It's part of approval. Income update pop-up inside existing account? Ignore it unless you want something specific like a limit increase. Credit limit increase request. Ask yourself if you actually need it. If not, decline it. Higher limits don't automatically equal financial progress. Banks calling asking to update your info. You can say no, politely. The relationship doesn't end. Loan requiring income verification. Provide what's legally required, not extras. If they ask for additional documents beyond necessity, ask why. Intentional disclosure beats automatic compliance. The lifetime value equation. Every bank calculates something called your lifetime value. How much profit will this customer generate over time? Income is a major input in that model. Higher projected lifetime value equals more aggressive retention and upselling. If you refuse to constantly update your income, you introduce uncertainty. Uncertainty makes algorithms conservative. Conservative treatment often benefits the customer. You become harder to optimize against. That's a quiet advantage. A real example. A friend of mine works freelance tech contracts. Some months, she earns $7,000. Some months, she clears $14,000. When she applied for a card, she reported conservatively. 2 years later, she updated her income after landing a major contract. Within 3 months, premium credit offers flooded her account. Personal loan emails tripled. Exclusive wealth products showed up. Calls from reps increased. She hadn't asked for anything. She'd simply updated data. The algorithm reclassified her. She stopped updating after that. The marketing intensity gradually faded. Data freshness drives attention. Remove the freshness, reduce the targeting. What this is not. This isn't anti-bank paranoia. Banks provide real value. Payment systems, credit, liquidity, security. But banks are profit-maximizing companies. Customer data is an asset. You are a revenue stream. That doesn't make them evil. It makes them rational. Your job is to be equally rational. The larger principle. Data minimization is powerful. Provide what's required, decline what's optional. Assume any information you provide will be analyzed, categorized, and monetized. That's not conspiracy thinking. That's how modern finance works. The more precise your profile, the more precise their pricing and marketing. Less precision benefits you when the relationship is asymmetric. And make no mistake, it is asymmetric. They know your spending patterns, your payment timing, your utilization trends. You know nothing about their internal models. Withholding optional data narrows that imbalance. The bottom line: next time you log in and that polite income update form appears, understand what's actually happening. They're not serving you, they're refining you. They want sharper data to better extract value from the relationship. You have three choices: comply automatically, lie, which you should never do, or decline optional disclosure and let your behavior speak instead. Consistent payments, low balances, long history. That's the data that genuinely matters. Income is just a lever, and you don't have to hand them the handle. Close the pop-up. Move on. Let your financial discipline, not your salary, define your profile.